If you've worked for a company that gave you stock in your 401k, listen closely. There's a hidden tax called Net Unrealized Appreciation, or NUA.
Join us as we break down how this NUA tax shortcut lets you take your company stock out of your 401k, pay regular income tax only on what you paid for, and pay long-term capital gains on the growth, even if you sell right away.
Today's episode is brought to you by Security Financial Management.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here with Senior Advisor here at Security Financial Management and Daniel Corson. Dan, what's cracking this morning, baby?
It's Friday.
It's Friday.
Yeah.
It's Friday! Woo! Yeah. It's been a long week.
Yeah.
We're going to get straight to it with the question of the day. Today's question comes from Clint from Atlanta, Georgia. Clint, what you got for us?
I have company stock in my 401k and haven't touched it for several years. What can I do to maximize my tax situation strategically?
Thank you, Clint. And great question. Yes, there's actually a powerful tax strategy called Net Unrealized Appreciation that lets you, when you retire or leave your job, take your company stock out of your 401k and move it into a brokerage account instead of just rolling the whole thing over into an IRA. Let's get to the expert here. Dan, please give us some insight.
We had a client who is a retiring executive for a Fortune 500 company that offered company stock in their 401k. This client invests a lot of their 401k in company stock early on. So $50,000 to be exact, that grew to $500,000, a gain of $450,000.
Wow.
We rolled that stock out, paid ordinary income tax on the $50,000 cost basis and capital gains tax on the gains. That saved over $76,500 in taxes.
Wow, $76,000. That's a nice save. But let's break it down. The initial investment was $50K. That's our cost basis. Today, that $50K is worth $500K. Now, $500K minus $50K gives us $450,000 of unrealized gains. First, he had to pay ordinary income tax of 37% on that $50K because we're assuming he's a high income earner. 37% of $50K is $18,500. Now he has to pay long-term capital gain tax on about 20% of that $450,000. 20% of $450,000 is $90,000. $18,500 plus $90K is about $108,500. So the total tax with NUA is about $108,500.
Exactly. And again, this is a unique situation. This particular client invested heavily in company stock very early in their career and then not so much afterwards. Hence, you had a lot of time for $50,000 of contributions to grow
30 years.
Yeah. And so it's not always that big of a gain to make an NUA strategy that attractive. But it was very attractive here, and they had a reason to take out the distribution to spend them. To put the money outside of a qualified account.
So what does the traditional strategy of something similar like this look like for like a normal advisor or a normal situation?
Well, there's only two options. You can roll everything over into an IRA, or you can pull out the company stock into a brokerage account and roll the rest into an IRA.
Okay, that makes sense. Is there a reason not to do an NUA strategy?
Oh, well, for sure. I mean, there's a reason why we don't do these more often. There can be complex, require specific steps and tax reporting. You also take an immediate tax hit. So you're paying taxes on a distribution up front when instead of deferring those taxes to a later date. There's also a capital gains tax risk. If the stock drops before you sell, the benefits shrink. And also, there's no step up in cost basis. In other words, if you hold that stock the duration of your life, someone inherits that stock, they're going to inherit the original $50,000 cost basis versus the appreciated.
Makes a lot of sense. Well, I hope that helps, Clint. If you want to talk to Daniel or any of our senior advisors here at Security Financial Management, we'll leave a link in the description. And remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.